Ladies and gentlemen, thank you for standing by. Welcome to the first quarter 2015 Rhino Resource Partners earnings conference call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session, and instructions will be given at that time. As a reminder, this conference is being recorded. I would now like to turn the conference over to your host, Scott Morris, Vice President of Investor Relations. Please go ahead.
Thank you, Matthew, and good morning, everyone. The earnings release was issued before the market opened this morning and is posted at the partnership's website at www.rhinolp.com. Participating in the call today are Joe Funk, Rhino's President and Chief Executive Officer, and Rick Moon, Executive Vice President and Chief Financial Officer. Before I turn the call over to Joe, I want to make a few general reminders. Our call today may contain certain forward-looking statements that are subject to a variety of risks, uncertainties, and assumptions, which are described more fully from time to time in the partnership's filings with the SEC. We refer you to these sources for additional information. Forward-looking statements are based on management's current expectations and assumptions, and actual outcomes and results may differ materially due to various factors. Rhino expressly disclaims any obligation to update or revise any of these forward-looking statements, whether because of future events, new information, a change in its views or expectations, or otherwise. A replay of this call will be available, and instructions for accessing the replay are included in today's earnings release. The webcast of today's call will be archived on our website for 1 year. With that, I'll turn the call over to our President and CEO, Joe Funk. Joe?
Thank you, Scott. I'd like to thank those of you who are participating in the Rhino Resource Partners first quarter 2015 earnings call. Our board reduced the current quarter's distribution from the previous level to further preserve the liquidity of the partnership as a prolonged weakness in the coal market continues to adversely impact cash flow. The recent amendment to our revolving credit facility ensures we will have the liquidity and flexibility to operate and manage the partnership through these difficult market conditions. The proactive steps that we have taken will help us navigate the partnership for long-term success as we focus on our liquidity and cash flow. We continue to adjust our production and cost structure to align with current market conditions. We believe our continuing attention to cost and production improvements at our ongoing core operations will enhance the liquidity of Rhino while retaining the flexibility to continue exploring non-coal investments, which we believe will enhance the long-term value of the partnership. Our priorities for 2015 will continue to be focused on preserving liquidity, continue controlling cost, only pursue capital spending with strong justification, and maintain our excellent safety record, all while responding quickly to the challenging and changing market conditions. Our balance sheet remains strong with relatively low debt levels and low legacy liabilities. We have kept debt levels relatively low with approximately $55 million drawn on the bank line of credit at the end of the quarter, which is relatively flat compared to the balance at the end of the year. We currently have no significant planned growth capital expenditures, and our investments to develop the Pennyroyal facility are nearing completion. We anticipate cash flow to grow at Pennyroyal and expect costs to improve at Hopedale. During the quarter, we continued to encounter difficult market conditions that have affected all coal companies. Conditions remain weak in all served markets with excess supply and low natural gas prices weighing heavily on coal. At Hopedale, poor rail service continued to constrain shipments from this operation, while costs remain higher than historical levels due to intermittent adverse geological conditions encountered in the advancement to the new Seven Seam Reserve. In addition, productivity was lower and costs were higher than anticipated at our new Pennyroyal mine due to the coal processing issues and geological conditions that we're working through as the mine continues its ramp-up. Our Castle Valley operation continued to perform well during the quarter, although lower contracted coal prices affect the result of this operation when compared to the prior year. Our Pennyroyal mine continued to ramp up production during the first quarter, and shipments were made to fulfill our base 800,000 ton per year contract. We have finalized a long-term sales contract with another local utility customer for 120,000 tons in 2015, 400,000 tons in 2016, and 550,000 tons in 2017. We have added a second mining section at Pennyroyal to increase the production capacity to fulfill the long-term sales contracts. We received permission for a deep-cut mining plan on the initial mining section at Pennyroyal, which has increased operating efficiency and has helped to lower our cost. We expect to receive a similar deep cut mining plan for the second section at Pennyrile, which will further improve our cost structure at this operation. Pennyrile gives us additional diversification, which we expect to be a significant generator of stable cash flow as it ramps up to its full potential run rate of 2 million tons per year. Our Castle Valley operation is sold out through 2016, while our Hopedale and Sands Hill operations in Northern App are sold out for the remainder of 2015. At Pennyrile, additional test burns may lead to additional sales contracts, which could bring this mine to its full potential run rate of 2 million per year. Market conditions in Central App have remained challenging, with continued depressed met and steam coal prices weighing on producers. In Central Appalachia, we have remained focused on safe operations while keeping costs as low as possible with reduced levels of production and sales. The dissolution of our Rhino Eastern joint venture in January of 2015 improved our cash flow and operating results in the first quarter by approximately $1 million when compared to the prior year. We anticipate the divestiture of Rhino Eastern joint venture will improve the partnership cash flow by approximately $6 million for the full year 2015. With that, I will now turn the call over to our CFO and Executive Vice President, Rick Boone, for a review of the financials. Rick?
Thanks, Joe. Good morning, everyone, and thanks for joining in this call today. Rhino continues to have a strong balance sheet with relatively low debt and leverage ratio when compared to many of our peers in the industry. At March 31, Rhino had total availability of $4.6 million, which included $0.2 million available in cash and $4.4 million available under our credit facility. In April, we amended our credit facility to provide additional liquidity and flexibility to operate the company. Based upon the new terms of our credit facility, our current availability is approximately $9 million. The amendment also includes an extension provision that provides for an additional 12 months, extending the facility to July 16, 2017. Looking at our results of operations, total revenue for the quarter was $56.2 million, and coal revenues totaled $45.6 million, both slightly down from Q1 of 2014 and down sequentially from Q4 of 2014. Other revenues for the quarter were higher at $10.6 million when compared to $8.7 million in 2014. In the first quarter, Rhino incurred a net loss of $3.9 million, and adjusted EBITDA for the quarter was $6.2 million, which was a sequential improvement compared to the fourth quarter of 2014. Coal revenues per ton decreased quarter over quarter and year over year due to the lower price of metallurgical and thermal coal at our Central App operations, as well as a higher mix of lower price tons from our Western and Northern App operations, as well as sales from our new Pennyrile mine. On a per ton basis, coal revenues in the first quarter were $52.18 per ton, compared to $60.53 per ton in the same period of 2014, a decrease of $8.35 per ton. Cost of operations per ton was $52.86 per ton in the first quarter of 2015, compared to $54.82 in the first quarter of 2014. The decrease in cost of operations per ton year to year was primarily due to improved cost at our Central Appalachia and Northern Appalachia operations. Rhino had actual maintenance capital expenditures of $1.8 million for the quarter, while expansion capital expenditures were approximately $1.3 million, which consisted primarily of payments for the final developments at Pennyrile. With that, I would like to turn the call back over to Joe for his closing remarks.
Thank you, Rick. We are focused on improving our future cash flow and maintaining our liquidity. We continue to have a strong balance sheet with relatively low debt levels compared to other competitors in the industry. Our amended credit facility provides us with sufficient flexibility to manage our operations during these challenging market conditions. On behalf of the board and the employees of Rhino Resource Partners, I thank you for your participation today. Operator, if you would, please open the call to questions.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star followed by 1 on your touch-tone telephone. If your question has been answered or you wish to withdraw your question, press star followed by 2. Press star 1 to begin, and please stand by for your first question. And your first question comes from the line of Mark Levin of BB&T Capital Markets. Please proceed.
Yeah, gentlemen, just a couple of quick questions. CapEx or maintenance CapEx for 2015. Can you remind me, what you're thinking this year? Has that changed at all over the last several months?
Our CapEx has decreased from, if we were looking at it from late last year, looking into this year. What we're doing, Mark, is utilizing assets, particularly out of Central App where we have cut back production. We're moving those assets to other operations in the company, which will help us lower our CapEx.
Got it. And then just in terms of the seasonality of earnings this year, when you think about, as the year progresses, Q2, Q3, Q4, does Q2 look better than Q1? I know Q4 tends to be one of the bigger quarters, if I'm not mistaken. But how do you kind of think about the earnings progression as the year unfolds?
Directionally, we will be near Q1. We did have a couple of one-time items that occurred in Q1 that will not reoccur, but directionally it's going to be probably slightly less than Q1, but not materially less.
Got it. And then the back half of the year?
The back half of the year is pretty consistent, Mark. We're looking at this run rate approximately north of $5 million per quarter.
Got it. And you referenced, I think, during the course of the call, looking at non-coal investments. Can you maybe elaborate a little bit on that?
Mark, this is Joe. We continue to, with our sponsor, Wexford, to look at opportunities that are an MLP qualifying income stream. I really can't comment on those that we're looking at, but those occur on a fairly frequent basis, and what we try to do is to try to look at anything that makes sense for us as an MLP and is of the right size. So really can't comment on any specific details, but those cross my desk with a regular frequency, and we take a pretty good look at each one of them for opportunities. There's several that we're looking at now, but haven't moved on for a transaction.
Great. And then last question, when you kind of think about your open position, at least as it relates to 2016, given given all the weakness in the market, both steam and even the domestic met market, is your view that if things don't change materially for the better, whether that's higher natural gas prices or a big summer weather, that you'll have to pull in some of your 2016 production numbers, i.e. take out some of the unpriced tons by just not producing them?
Yeah, the first place we would look to do that, of course, would be in Central App. We're sold out at Penny Rock, Castle Valley. We have some tons in Northern App to sell, but the first tons that we would pull out would be Central App if the market does not improve.
Got it. And when you think, just one last question, just margins in Northern App, how obviously with Penny Royal sort of ramping, can you give us some thoughts about how to think about what is a normalized margin or what a margin might look like in Northern App going forward?
Those margins right now are very good, as you saw in our release. If pricing goes down there, we can see those margins slip slightly. As mentioned, we have some coal to sell there next year, and if we were contracting those today, we would see those margins potentially go down slightly.
Just slightly, not materially?
Correct.
Okay, great. Thanks, guys. Appreciate it.
Thank you.
Thank you for your question. As a reminder, ladies and gentlemen, to ask a question, please key star followed by 1 on your telephone. There are no more questions, so I'd like to turn the call back over to Scott Morris for the closing remarks.
Thank you, Matthew, and I'd like to thank everyone for participating in the call today, and we will speak to you again next quarter. Thank you.
Thank you for joining in today's conference, ladies and gentlemen. This concludes the presentation. You may now disconnect. Have a good day.